great to see everyone. My name is Melissa. I'm with the Cooperative Credit Union Association, and we are going to introduce James from Salus. And just a little bit of quick background before I pass this over and we get to hear from James. Earlier this summer in June, in the wonderful state of New Hampshire, we had a Fintech event, very well attended, and we had some great Fintech partners who were able to attend. Purpose of that event was to really introduce our member credit unions to some of the innovative solutions that are out there, and create an atmosphere and an environment where our credit unions can really interact and mingle and get to know some of these innovators and some of the products and solutions that are available to their credit unions. We had such great feedback on a handful of the fintechs in particular, that what we wanted to do was give our member credit unions the opportunity to hear from them again and actually see what product or service or solution they have to offer your credit union. So Salus was one of those credit unions that was incredibly well received. We loved hearing from James. We were very happy that he was able to participate in our event. And we have an excellent presentation that James has prepared for us to really show what his solution and his product can do for our credit unions. And I will just preface this with the first time I was introduced and had a conversation with James, I was very impressed by how his product resonated with one of the very particular and specific needs that we have in the credit union industry. It relates to attracting and retaining a younger generation, and the way that James has developed his product and solution to do that, I think, is a game changer in our industry. So I'm really looking forward to seeing Salus grow within our member credit unions and in the industry as a whole. So without further ado, enough for me. And James, I'd like to welcome you again and thank you for offering this webinar for our member credit unions. I'll pass it off to you.
So thank you, Melissa. I don't know that I can add much to that intro. Really appreciate the time and excited to share some perspectives. And what this is about is how young consumers use financial services in 2024, perspectives on the under 40, or what I will refer to as the U40 crowd. If you think about the U40 crowd, what we're talking about is Gen Zs and millennials. For those that don't know, the oldest millennials are actually 43 years old now. The youngest millennials are around 27, 28 years old. Gen Zs, the oldest Gen Zs are 27, 28 years old. The youngest Gen Zs are actually teenagers. So it's a broad swath. They are going through a number of different things, maybe in a different way than some of the older generations like Gen X and baby boomers are going through. And we're going to walk through a couple of those things in terms of how are they doing relative to other generations right now? What are they looking for? And what's really winning amongst the younger cohort, the U40 cohort? So we are going to start with how are the U40s doing? So how do the headlines relate specifically to the generational groups? This data is taken from a Federal Reserve survey called the Economic Well-Being of U.S. Households. And so let's start with the first question that they ask. How well are you managing financially these days? There are four real responses that people give: living comfortably, doing okay, just getting by, and it's difficult to get by. And we're going to focus on the last two, just getting by and difficult to get by. And if you look at this survey result over the last several years, you'll notice a couple things. First, you'll notice that during the pandemic in 2021, maybe counterintuitively, the number of people who were just getting by or struggling to get by actually went down. It went from 25% in 2020 to 22% in 2021. Now, there are a couple of reasons for that. The amount of economic stimulus dollars that were flowing through the system contributed to that. The limited ability of people to go out and spend money, frankly, because so many things were closed, contributed to a surprisingly good number in 2021. What you'll also notice in the 2 years since, that number has reverted. It's actually reverted to 28%, which is slightly higher than it was going into the pandemic in 2020. Now, if you look at 28% of adults getting by or struggling to get by, it's important to note that this number looks different across the different generational groups. So if you split that 28%, only 18% of baby boomers, 60 plus, are just getting by or struggling to get by. By comparison, 34% of Gen Zs are just getting by or struggling to get by, and 34% of millennials are just getting by or struggling to get by. That means 1 in 3 U40s isn't really doing okay financially, which is not what the headline would necessarily point you towards. So the next headline, one of the questions asked in the survey is, have you set aside an emergency fund that covers 3 months of expenses in the case of job loss, sickness, economic downturn, et cetera? And again, you'll see something similar in the data here. Kind of counterintuitively, during the pandemic in 2021, the number of people who didn't have 3 months of emergency savings went down to 41% from 45%. Again, economic stimulus dollars going through the system, less places to spend money, a surprising result. But in the 2 years since, we've seen that number go back up to 46% of people not having 3 months of emergency savings. Again, slightly higher than it was going into the pandemic. And once again, you'll see that this does not cut across generational lines in a straight line. For baby boomers, about 1 in 3 people don't have 3 months of emergency savings. But if you look at Gen Z, 61% don't have 3 months of emergency savings. 53% of millennials don't have 3 months of emergency savings. This is a really important distinction to make because it tells you, in a way, that what people are going to worry about in the younger cohorts is going to be a little bit different than what the older cohorts are going to be worried about. And last, and just as important, this is a question that I think gets a lot of play in a lot of articles around the country. The question posed is, suppose you have an emergency expense that costs $400. Would you pay for this expense with cash or an equivalent, or would you use something else? And this is a number that you may have heard in articles or discussions around financial health and wellness. 37% of people can't afford an emergency $400 expense. This is the question that generates that number. And again, you'll see in 2021, during the pandemic, this number counterintuitively goes down to 32%. And then in the 2 years since, it's gone back up to 37%, slightly higher than it was going into the pandemic. And once again, you'll see that 37% does not cut equally across generational lines. 23% of baby boomers couldn't afford a $400 emergency expense using cash or its equivalent, where 48% of Gen Zs can't and 45% of millennials can't. This is a really important distinction. Nearly half of the U40s have trouble with even a $400 emergency expense. Now, if you think about these responses, there are a number of contributing factors. Typically, younger people are in lower level jobs than their older counterparts, so their incomes are lower. They have student debt expenses. They haven't built up the same access to credit. But regardless of the reason, the U40s are doing a little bit worse than their Gen X and baby boomer counterparts, and it's manifesting in very specific ways around emergency savings and how they handle financial emergencies. So now that we kind of have a sense of how the U40s are doing, let's talk about what U40s actually want. What's the same for them versus their older counterparts, and what's different? And this data is taken from Modern Banking Experiences for Gen Zs and Millennials, which is a study done by MX. So the first that I think we can actually dispel, which I think is a bit of a misconception amongst the younger cohort, is if you look at who they would trust to securely manage their personal financial data. A lot of people talk about the idea that Gen Zs and millennials, they don't trust banks, they don't trust credit unions, they would rather go with a fintech or a tech company entrant, that's where their trust lies. And that's actually not true. If you look at who Gen Zs and millennials trust in terms of national banks, credit unions, local regional banks, the highest trust levels are with those institutions, just like it is with the baby boomers. And just like baby boomers, if you look at their level of trust in terms of managing data for fintechs and tech companies, it's really low, just like it is for the baby boomers. So in terms of actual who they trust to securely manage their personal financial data, Gen Zs and millennials aren't that different from their Gen X and baby boomer cohorts. And if you look at how much they trust those institutions to manage that data, again, Gen Zs and millennials aren't actually that different from baby boomers. If you look at how much they completely trust their institutions to manage the data, 38% for Gen Zs, 36% for millennials, not that different from baby boomers at 47%. And if you combine whether they somewhat trust or completely trust their institution to manage their data, it's 80% for Gen Zs, it's about 80% for millennials, which is pretty much the same as it is for baby boomers. This is a big misconception that people have about where trust lies for financial institutions and how younger generations actually perceive those financial institutions. And I think it's really important to draw this distinction between perception and reality. Now, this is where there is a bit of a difference. What interests do different cohorts have in the services they want to see from the bank and credit union? You're going to see across the board good identity and credit programs, good data protection, which is not surprising given the last survey responses. But here's where things get different. Gen Zs and millennials are going to disproportionately look for automated financial guidance in money management relative to their older counterparts. They are going to look for a higher interest in virtual assistance in managing their money. Again, there could be a number of contributing factors to this. If you think about baby boomers and even Gen X, they have higher levels of assets. That may mean that they are more easily engaged with certified financial planners and wealth managers, et cetera. They may have more experience in general with how they manage their money. But if you look at Gen Zs and millennials, they don't maybe have access to the same financial planning or the same asset management. They don't have as much experience managing money. And as the survey we looked at earlier alludes to, they have more pressing issues on a short-term basis in managing money. So they clearly have a differentiated interest in looking for automated financial guidance and virtual assistance in managing their money, both in the short term and in the long term, which is a key difference for the U40s relative to their older counterparts. Now that we've looked at how they're doing and what they want, what is actually winning with the U40 cohort? Let's make some observations from the actual products that they're using. Now, when you think about checking accounts, most institutions will tell you how many checking accounts they have, but the reality is that many people have more than one banking relationship. They have more than one set of accounts. And the thing that most institutions are looking for is that primary financial institution relationship. The primary checking account is at my institution. And this data is from Cornerstone Advisors. If you look at primary checking account market share, if you look at the top of the list, you're going to see some familiar names or what you would expect. Bank of America, JP Morgan Chase, Wells Fargo, with pretty large primary checking account market share. And you're going to see some other large banks on this list. But what's really interesting is the names highlighted in light blue here: Chime, PayPal, Cash App, and Dave. These are, in the case of Chime and Dave, digital neobanks that started in the last 5 to 10 years. In the case of PayPal and Cash App, these are organizations that started as peer-to-peer transfer systems where people can send money to another individual through their account, that have built up a primary checking account offering and are winning share. And not only is this important because if you add up the share of these 4 players, it actually adds up to the combined primary account share of all credit unions in the US. But that's not the most important thing about this share. If you look at Chime, if you look at Cash App, if you look at Dave, their user base is 75% Gen Z and millennial. This is very different from every other institution on this page. So it begs the question, how are Chime, Cash App, and Dave amassing this level of market share and doing it disproportionately with the U40 cohort? So if you go look at the features that are offered by Chime, Cash App, and Dave, if you just go to their website and look, you are going to see a lot of different features. It's a lot to take in, frankly. It's everything from discount offers with affiliated merchants to side hustle income sources to quoting APYs on their savings accounts. There's a lot of different features. But if you actually look for the things that are helping them win with customers, they actually tell you out front. Dave is a neobank with over 10 million users. They have over 10 million primary checking account users, and they publicly report their results. It's a publicly traded company. And I'm going to directly quote what they say in their earnings presentation. We differentiate by addressing members' most crucial need, liquidity, and then building a long-term banking relationship around that solution. This is something that they have said for years. This is their differentiating strategy to win users and turn them into members of Dave. And when you look at it through that lens, if you relook at the key features that are being offered by Chime, Cash App, and Dave, what you actually see is a series of features that helps U40s deal with short-term credit. Earned wage access. This is access to wages that you have earned but are not going to get paid until payday. So it's getting access to a portion of those wages maybe a week before payday and then paying it back when you get paid. Cash advances and microloans are loans of an extremely small dollar size, so less than $400. In the case of Dave, their average cash advance microloan is $150 that they give to their members. No fee overdraft, getting paid 2 days early. These are all forms of helping U40s manage short-term money issues. And if you're not sure about how big this is, just for context, Dave reported their second quarter results a few days ago. To their members, they issued $1.2 billion in cash advance microloans to their members in the 3 months ended June 30th of 2024 at an average size of $150 per cash advance microloan. This is how they have been able to grow their membership by 2 million members in each of the last 2 years. So when you zoom in on the feature set that these neobanks are winning Gen Zs and millennials with, it has a lot to do with solving this short-term liquidity need. And that's not the only data source that we have to see where people are winning with Gen Zs and millennials. If you go to the Apple Store and just look at the top 100 apps, if you look at the finance apps, you'll see that 3 categories consistently are in the top 3. It's apps focused on investing, it's apps focused on cryptocurrency, but number 3 is apps focused on cash advances. These are cash advance microloans as small as $50 and as large as $250. It's the number 3 category of apps being downloaded on the Apple Store every day. It's ahead of the top 20 US bank apps. It's ahead of even the peer-to-peer payment providers. And if you actually combine cash advance apps, neobanks like Chime and Dave that offer microloans, and earned wage access, it's actually 20% of the top 100 apps in the App Store are offering users some form of access to microloans. This ties back to what we saw in the survey. You don't have a lot of emergency savings. You have trouble meeting unexpected emergency expenses with cash. This is why this need is so prevalent among the U40 cohort. So what are the key takeaways here? Well, first, just know as a general working order that in the current financial environment, things are tougher for Gen Zs and millennials than they are for their Gen X and baby boomer counterparts. That's just a product of the environment that we're in today, and it's much more acute for those younger consumers. Second, Gen Zs and millennials are looking for solutions that are virtual and tailored to the specific needs that they have. Then those needs can be different from Gen X and baby boomers. And third, they are actively choosing products and financial institutions that are solving their pressing needs and desires. That means microloans, that means cryptocurrency, and that means investing. So if you wanted to tailor a microloan offering to target Gen Zs, how would you do it? Well, as a digital underwriting platform that empowers institutions like credit unions to make microloans to their members, we have a couple recommendations. First, make sure there's access to it 24/7. Small dollar and microcredit emergencies do not happen between 9 and 5 p.m. exclusively, Monday through Friday. People need access to the application and real-time funding, no matter what day of the week it is, no matter what time it is. So that's a critical component of any microloan offering. Also, smaller loan sizes. Typical financial institutions tend to think of small dollar loans as a couple of $1,000s. But again, Dave's average cash advance is $150. In our data, we see that the average microloan size is about $100 that these users are looking to get. And third, and maybe most importantly, when you underwrite a microloan borrower, you really can't rely on credit score. If you had an underwriting model that was going to look at these particular microloan borrowers with a cutoff of 660, 640, 620, you're going to not only remove the majority of applicants for this product, because 95% of borrowers of microloans lack a prime credit score, you're also going to exclude a lot of the people that are going to repay these loans on time and in full. Because in the Salus microloan data set, and again, we've been empowering partners to make microloans to their users for about a year and a half. We've got over 9,200 loans in our data set. 95% of the microloan borrowers that repaid on time and in full didn't have a prime credit score. So with that, if you'd like to learn more about what we do, I've got a QR code here on the screen. You can scan to connect and learn more. If you want to learn more about what we do, salusfintech.com, or you can connect with me directly on LinkedIn. Thank you for your time, and would love to open up the floor for questions.
So thank you so much, James. Go ahead, you can unmute or you can use the chat to ask a question if that's helpful.
I have a question while we're maybe waiting for some others to come in. And James, this is really just something that I think would be very helpful for our members that are on the phone to hear. And that is in your research and in the data that you have access to, would you say, this is a bit of a softball, but would you say that some of our member credit unions are currently missing out, not generally speaking, but very specifically in terms of members of our credit unions are absolutely going to these other apps, and you can actually hone in and pinpoint which ones they are?
Yes, that's absolutely true, Melissa. In our data that we have, and we work with fintech lenders as well to see who's using microloans and help them facilitate some of those microloans, we can see who the primary checking account is in terms of what institution they're working with. And we know that CCUA affiliated credit unions have members today online applying for microloans from a variety of sources. And maybe some of the most pernicious sources from a credit union perspective are going to be the Daves, the Moneylines, the Chimes, because those institutions are specifically offering that microloan as a way to steal that member away and turn a credit union member into a Chime member, into a Dave member, into a Moneyline member. And we know from our data that roughly half of CCUA credit unions, at minimum, have members actively seeking these types of microloans online right now.
And I think that's compelling because we're talking not only about helping existing members, but maybe retaining that member for the long haul, which I know for a fact is a strategic objective for most, if not all, of our member credit unions. And this seems like a immediate gratification for the member. Also, laying the groundwork to really be able to help them and develop a strong relationship with those members. So I know the first time you showed me that, James, I was surprised, and I said, let's contact those credit unions, and why wouldn't they want to know more about this immediately?
No, it's a really important point. I think what we've had in our early conversations is when a lot of people think about who uses microloans, who would need a product like this, there's kind of a thought that it might be a different population or a different group of people than maybe the people that are using our particular credit union. And what I can tell you is that the median age of a microloan borrower is 29 years old. We know that 80% of microloan borrowers make between $30,000 and $70,000 per year. So it's a middle income consumer. And their issue is they don't have access to traditional credit, like we've seen in the survey data across the country. And so when they have this need and they can't go to their credit union to get it solved, they go somewhere else.
Yep.
And sometimes when they go somewhere else, that's the beginning of a relationship. that ends with them leaving the credit union because that neobank is serving their needs more effectively.
Excellent. One
James,
more.
Oh,
Go ahead,
go ahead.
Amy, go ahead. No, I was just
Yeah,
gonna make,
I'm sorry, go.
I was just gonna make a quick point about the generations, and it always surprises me every time how underrepresented Gen X is on all of these conversations. So we hear about baby boomers and we hear about millennials and Gen Z. So I just wanted to put a plug in for any Gen Xers that are out there on the call.
The one thing that I will say about the Gen X data is it's always pretty close to the overall headline number. They're always doing pretty close to a headline. It's always baby boomers are doing better and the younger cohorts are doing worse. And Gen X is, it's
Keeping the trains running. Absolutely.
Exactly. Very silently keeping the train running.
I
Go
did
ahead,
have a
Amy.
question. You had showed some stats before. Why do you think it is that younger consumers have problems getting those access to credit as opposed to, the Gen X and the baby boomers?
No, it's a good question. If you think about credit score, most credit bureaus will quote that an average credit score for everyone is somewhere in the 700 range, which sounds like a prime credit score. But the reality is that if you look at the average credit score by age, it's always lowest for people in their 20s, and it doesn't actually recover up to that average level until sometime into the mid to late 30s. And the reason for that is that most people, when you're starting out, if you think about you don't have a lot of payment history, you may have student debt that is a large loan obligation. You haven't built up a lot of credit that you have that's unutilized. You may be utilizing every piece of credit that you have access to. You generally haven't built the kind of profile that allows you to have a high credit score. And that basically locks you out of credit access for any credit product that's going to rely on FICO or a credit score equivalent from an underwriting perspective. Even for a lot of the alternative underwriters, you will see that credit score kind of creeps in. So younger consumers have to find alternative means to solve this problem because traditional underwriting doesn't necessarily recognize them as creditworthy yet.
Thank you. We did have another question in the chat. The average age of the credit union I'm sorry, of the member at their credit union is 52. Do you want to take it, Matt? Do you want to just ask your question? Okay. But the mode is 62. Do you think that your products naturally attract younger folks? And in your opinion, who has an excellent marketing campaign for getting that younger demographic?
Yeah, one of the things that we see a lot with the credit unions that have moved forward with a microloan program or a small dollar program is what they tend to see is when they launch it, even without marketing, they are already getting interest. And there's one actual credit union in New England that started a small dollar loan program years ago. And what they found is not only are their existing younger members using it, but they're actually referring their friends to the credit union saying, hey, these guys have a great product. I use it. It's fantastic. And it's actually generating referrals for them without them even intending to do so. That's kind of what's happening on the anecdotal side. But I think from a data-driven side, you can clearly see that the institutions that are targeting this type of a product as a part of their customer acquisition strategy are seeing a disproportionate of share coming from the younger cohort.
We have one more in the chat. While discussing the difficulties with using FICO and risk scoring, you mentioned a stat around what percentage of those loans are paid back. Can you repeat that stat and maybe talk a little bit more about what the term of these microloans tend to be?
Sure. When you look at it from the Fintech neobank perspective, the ones that they offer tend to be literally 2 weeks to 4 weeks long in terms of overall tenor. They don't actually look that different in term structure from a payday loan. What we power at Salus is more of a traditional loan offered over a 1, 2, 3, or 4 month term. And so the average credit score is 571, 572 for people that we see borrowing microloans. With that credit score, you should expect those borrowers to default based on what their credit score implies about 56% of the time. And what we've been able to do with our model by utilizing member transaction data and other data sources is we've been able to reduce that default rate by anywhere from 70 to 90%. So a credit union that really wants to tighten down default rates and charge-off rates can have a really conservative profile, still lend to people with a deep subprime credit score, but have significantly smaller default and charge-off rates. And people that have a little bit more risk tolerance, are interested in the community impact aspect of it, can turn that risk meter up and have a broader reach in exchange for slightly higher defaults.
Awesome.
Thank you.
So much.
Anyone else? Any other last second questions here? Okay. Do you want to close us out, Melissa?
Absolutely. Thank you, everyone, for joining. And James, I love this presentation. So thanks for running through it. And we look forward to partnering with you and seeing you again soon.
Yeah, I would say if you guys are planning on attending Apex in October, we will be there. So hopefully I will get to see some of you in person in a little while.
Sounds good. Thanks, James.
Thanks, everyone.